Something has shifted, not in the headlines, not in the noise of daily market chatter, but in the deeper currents that move capital, shape policy, and ultimately determine what holds value when systems are tested. If you've been watching gold break records while the financial media celebrates its rise, you're seeing only half the story. The other half is happening in silence. It's happening in the physical silver market, and it's happening now. This isn't about hype. It's not about getting rich quickly or timing a perfect trade. This is about understanding a structural change that's already underway, one that most investors won't recognize until it's priced in, and the opportunity has fundamentally changed. I'm speaking today to two groups of people. First, to those who already understand why precious metals matter and have taken positions accordingly. You need to know what's happening beneath the surface, so you can hold with conviction through what comes next. Second, to those who've been watching from the sidelines, perhaps skeptical, perhaps waiting for clarity. You need to understand why this moment is different from the speculation cycles of the past, and what that difference means for your financial resilience. Let's be clear from the start. I'm not here to tell you silver is going to a specific price by a specific date. I'm here to walk you through the mechanics of what's occurring in the global financial system, why silver sits at the intersection of multiple critical pressures, and how thoughtful investors navigate uncertainty without losing their discipline. The crisis isn't coming. The crisis is here. It's just not distributed evenly yet. For the past 2 years, gold has been the story the financial world felt comfortable telling. Central banks buying at record levels, geopolitical tension driving safe haven demand, a clear, simple narrative that fits neatly into traditional investment frameworks. Gold's rise to new all-time highs has been orderly, institutional, and publicly acknowledged. It has done exactly what it's supposed to do when confidence in fiat currency systems begins to erode. But while gold commands attention, silver has been moving differently, not with fanfare, not with institutional press releases, but with a pattern that experienced market observers recognize from previous cycles, the quiet accumulation phase that precedes violent price discovery. Here's what's changed in the last 18 months that most people haven't connected yet. Physical silver inventories at major exchanges have declined significantly while industrial demand continues to rise. This isn't speculation. It's reported data from COMEX, the London bullion market, and government surveys of industrial consumption. At the same time, new supply from mining operations has remained essentially flat. Silver production peaked years ago in many major producing regions, and despite higher prices, new large-scale discoveries haven't materialized in meaningful quantities. Meanwhile, the energy transition that governments worldwide have committed to, solar panels, electric vehicles, grid infrastructure, requires silver in quantities that existing supply chains weren't built to handle. Add to this the monetary pressure that's driving gold, currency debasement, deficit spending on an unprecedented scale, and the slow unwinding of the dollar's unchallenged dominance in global trade. What you have is a situation where silver faces both industrial scarcity and monetary demand while trading at historic lows relative to gold. The gold to silver ratio, which has averaged around 50-1 historically, recently touched 90-1. That means you needed 90 ounces of silver to buy 1 ounce of gold. From a historical perspective, that's an extreme divergence. These extremes don't last, not because markets are fair, but because they're eventually rational. The average investor hears silver and thinks of one thing: volatility. They remember the Hunt brothers' manipulation in 1980. They recall the speculative spike in 2011, followed by years of grinding decline. They see silver as a trader's game, not a serious asset. This perception exists for a reason. Silver is volatile. It has smaller markets than gold, which means price swings can be dramatic. And yes, it attracts speculators who amplify those swings, but this misses the fundamental nature of what's happening now. Silver isn't rising because speculators decided to pump it. It's being accumulated because sophisticated players understand supply constraints in a world that's committed to technologies that cannot function without it. When you look at the physical market, the actual metal, not the paper contracts traded in futures markets, the picture becomes clearer. Premiums on physical silver coins and bars have remained elevated for months, even when spot prices were suppressed. That tells you something about real demand versus paper price. Mints around the world have struggled to keep up with orders. Delivery times have extended, and yet the price, as quoted on exchanges, hasn't reflected this physical tightness. Why? Because the silver market, more than almost any other commodity, is dominated by paper trading, contracts for future delivery, derivatives, financial instruments that represent silver without requiring physical metal to change hands. This creates a disconnect. The paper market can suppress price through selling that doesn't require actual metal, but eventually, physical reality asserts itself. When enough people demand delivery, when industrial users can't source what they need, when the gap between paper and physical becomes untenable, that's when price discovery happens violently. We've seen this pattern before, not just in silver, but in any market where paper claims exceeded physical supply. It always resolves the same way, in favor of physical reality. To understand why this matters now, you need to understand the broader economic environment we're operating in. We are living through the largest debt expansion in human history. Governments worldwide have borrowed on a scale that previous generations would have considered impossible. The United States alone is carrying debt levels that exceed World War II in relative terms, with no clear plan for reversal. This debt must either be serviced, defaulted on, or inflated away. Those are the only options. And history shows which option governments prefer. Inflation is how you reduce the real burden of debt without formally defaulting. You repay in currency that's worth less than when you borrowed it. It's politically easier than austerity and less disruptive than default. But inflation destroys something else, confidence in currency as a store of value. And that's where precious metals enter the picture. Gold has already responded to this dynamic, but silver, with its dual nature as both industrial metal and monetary asset, faces additional pressure. Consider the energy transition. Whether you believe in the climate narrative or not is irrelevant to the investment thesis. What matters is that governments have committed trillions to electrification, renewable energy, and grid modernization. Silver is irreplaceable in solar panels due to its conductivity. Electric vehicles use significantly more silver than traditional cars. Grid infrastructure requires silver for efficiency at scale. This demand is not discretionary. It's baked into policy commitments that span decades. At the same time, interest rates, which determine the opportunity cost of holding non-yielding assets like precious metals, are in a structural bind. Central banks raised rates to combat inflation, but they cannot sustain high rates indefinitely with current debt levels. The interest expense alone becomes unsustainable. This creates a trap. Keep rates high and risk economic contraction and debt crisis. Lower rates and risk reigniting inflation while punishing savers. In either scenario, hard assets with no counterparty risk become attractive. Gold has reflected this. Silver, which trades at a historic discount to gold while facing industrial constraints, represents asymmetric opportunity. Let's look at history without cherry picking. In the 1970s, when inflation expectations became unanchored and currency confidence eroded, precious metals didn't move in straight lines. They moved in explosive bursts, separated by frustrating consolidations. Gold went from $35 in 1971 to $850 by 1980. But that journey included a 50% drawdown in 1975-1976 that shook out most early buyers. Silver moved even more dramatically, from under $2 to $50 in the same period. But again, the path was volatile, painful, and designed to exhaust weak hands. What separated those who captured the move from those who sold at the bottom? Understanding the underlying forces and refusing to react to short-term price action. The same pattern appeared in the 2000s. Gold bottomed around $250 in 1999, then climbed to $1,900 by 2011. Silver went from $4 to $49 in the same period. But both metals experienced sharp corrections along the way that tested conviction. In 2008, silver fell from $21 to $9 in a matter of months, even as the financial crisis validated every reason to own it. Those who understood the cycle and held through volatility were rewarded. Those who sold in panic or chased price lost. Here's what history teaches about these cycles. They last longer than skeptics expect and move further than early believers imagine possible. But they don't move smoothly. The current environment shares characteristics with both the 1970s and the 2000s. Currency debasement, debt accumulation, geopolitical instability, and loss of confidence in institutions. But there's an additional element now. The supply-side constraint in silver that didn't exist in previous cycles to the same degree. In the 1970s, you could increase silver production relatively quickly by ramming up mining. Today, most easy deposits have been exhausted. New mines take years to permit and develop. Recycling has limits. This means the supply response to rising prices will be slower and smaller than in previous cycles, which, in turn, means price moves could be more sustained once they begin in earnest. If you already own silver, your challenge isn't deciding whether to buy. It's deciding how to hold through what comes next. The first thing to understand is that you're going to be tested. If this cycle follows historical patterns, there will be moments, potentially soon, where the price drops sharply despite improving fundamentals. Maybe a liquidity event in broader markets. Maybe a coordinated effort to shake out leveraged positions. Your conviction needs to be rooted in something deeper than price action. It needs to be based on understanding why you own the asset in the first place. Are you holding silver as insurance against currency debasement? Then short-term price swings are irrelevant. The insurance value doesn't change because the premium fluctuates. Are you holding it as a value play based on the gold-silver ratio? Then you need to be patient enough to let that ratio revert, which could take months or years. Are you holding it for industrial demand exposure? Then you need to understand supply dynamics won't change quickly, regardless of what futures markets do. The second thing current holders need to understand is position sizing. If your silver position is so large that daily price swings affect your decision making, you're probably overexposed. The right position size is one that lets you sleep at night and hold through volatility without panic selling. That varies by individual, but as a general rule, precious metals should be a meaningful but not overwhelming part of a diversified strategy. For most investors, this means somewhere between 5 and 15% of investable assets, with exact allocation depending on risk tolerance, time horizon, and conviction level. If you're properly positioned, you can ignore the noise. You can watch paper price get hammered while physical premiums rise and understand what that means rather than panicking. The third thing is understanding the difference between trading and holding. If you're trying to trade silver, buying dips, selling rips, you're playing a different game than positioning for a structural shift. Trading requires different skills, different risk management, and different time commitment. Most people who try to trade precious metals end up selling before major moves or buying back higher after getting shaken out. If you believe in the thesis, currency pressure, supply constraints, industrial demand, then your strategy should be accumulation and patience, not clever timing. If you haven't entered a position yet, you're facing a different set of questions. The first is whether you understand and accept the thesis. If you don't believe currency debasement is real, if you think debt levels don't matter, if you're confident industrial demand will be met easily by supply, then silver isn't for you. Don't buy something you don't understand or believe in. But if you do see the structural pressures, the next question is timing. And this is where most people make mistakes. They wait for absolute confirmation. They want silver to break out decisively before buying, so they know they're right. By the time that confirmation comes, most of the move has already happened. Or they try to bottom tick, waiting for the perfect entry. They watch price drop and think they'll buy when it gets cheaper. Then it rallies, and they wait for it to come back down. It never does. They buy eventually at higher prices or miss it entirely. The alternative approach is to think in terms of scaling in rather than timing perfectly. If you believe the thesis, start building a position at current levels and increments over time. This removes the pressure of needing to be right about exact timing. Dollar cost averaging into silver over several months smooths your entry price and keeps you from being paralyzed by trying to call the bottom. The second consideration is how you hold it. Physical metal in your possession provides maximum security but comes with storage considerations and less liquidity. ETFs provide liquidity but introduce counterparty risk and don't give you the same crisis protection as physical. Mining stocks offer leverage to silver prices but come with company-specific risks and broader equity market correlation. Futures and options offer even more leverage but require expertise and carry substantial risk of total loss. For most investors new to the space, a combination makes sense. Primarily physical metal for core holdings, with perhaps a smaller allocation to well-managed ETFs or quality mining companies for additional exposure. The key is understanding what you own and why. Don't buy silver futures if you don't understand how they work. Don't buy a mining stock just because someone on the internet said it would 10x. Start with the basics. Understand the asset, understand your thesis, and build conviction through education rather than following hype. There's an element to this story that makes some people uncomfortable but needs to be addressed directly. The role of paper markets in price formation. The silver market is one of the most heavily traded commodity markets relative to physical supply. This means the price you see quoted, spot price on exchanges, is determined more by paper contract trading than by physical metal changing hands. This isn't conspiracy theory. It's openly acknowledged market structure. Futures markets exist to provide liquidity and price discovery, but they also allow for leverage and speculation that can disconnect from physical fundamentals. When a large institution wants to suppress price, whether to protect short positions, manage risk, or influence markets, the most efficient way is through futures selling. You can sell contracts representing millions of ounces without actually possessing the metal. This works fine until someone demands delivery. And this is where the current situation gets interesting. There have been increasing reports of delivery delays, tightness in physical markets, and divergence between paper prices and physical premiums. This suggests the paper market's ability to control price may be reaching limits. When paper price gets too disconnected from physical reality, arbitrage opportunities emerge. Buyers can purchase paper contracts, demand delivery, and sell physical at premiums. This forces convergence. We may be approaching that convergence point. Not because of manipulation ending, market structure doesn't change quickly, but because physical scarcity makes the manipulation harder to maintain. This is important context for understanding price action. If you see silver get smashed lower on heavy futures, selling despite strong physical demand, that's not a reason to panic. It's the mechanism through which paper markets try to maintain control. But it's also opportunity. If you understand the divergence, you can use paper price weakness to acquire physical metal at discounts that don't reflect actual supply-demand dynamics. The hardest part of navigating major market shifts isn't intellectual, it's emotional. When prices are rising, everyone feels like a genius. Conviction is easy. Holding is easy. Even adding to positions feels natural. But the real test comes in the drawdowns. When your position is underwater, when everyone is telling you you're wrong, when the financial media mocks precious metals, investors as paranoid doomers. That's when psychology matters more than analysis. Here's what separates investors who capture generational moves from those who get shaken out. They do the hard work of conviction building before the test arrives. They understand their thesis well enough that price action doesn't change their mind. They've sized positions appropriately so they can be patient. They've accepted volatility as the price of admission rather than being surprised by it. And critically, they separate their ego from their portfolio. They don't need to be proven right immediately. They don't need validation from others. They can sit with uncertainty and wait for outcomes to unfold. This might sound abstract, but it's deeply practical. Your ability to hold through a 50% drawdown determines whether you capture the 300% run that follows. Your ability to ignore mockery and maintain conviction determines whether you sell at the bottom or buy more. Your emotional control, in other words, is as important as your analysis. Let's be explicit about the mistakes that destroy capital and conviction in markets like this. First, don't lever up. Don't borrow to buy silver. Don't use margin. Don't put money into the market that you might need in 6 months. Leverage turns volatility from uncomfortable to catastrophic. It forces you to sell at exactly the wrong time. It amplifies losses and creates risk of total wipeout. Even if you're right about direction, poor timing combined with leverage can bankrupt you before the thesis plays out. This is how people lose everything while being fundamentally correct. Second, don't chase headlines. When silver spikes 10% in a day and financial Twitter erupts with excitement, that's not when you go all in. That's when emotional late buyers create the fuel for pullbacks. Similarly, when price drops and panic spreads, that's not when you abandon your thesis if nothing fundamental has changed. Headlines create noise, not signal. Your strategy should be based on understanding longer-term forces, not reacting to daily drama. Third, don't blindly follow influencers. The internet is full of people making bold predictions about silver going to triple digits. Some may be knowledgeable. Others are selling courses, premium content, or their own positions. Your conviction needs to be your own. By all means, learn from others. Study their reasoning. But verify everything against your own research and thinking. Fourth, don't neglect the rest of your financial foundation. Silver isn't a substitute for emergency savings. It's not a replacement for retirement planning. It's not a reason to ignore basic financial discipline. You should have adequate cash reserves for emergencies. You should be managing debt responsibly. You should have diversified income sources if possible. Precious metals are one component of a resilient financial strategy, not the entirety of it. Fifth, don't let this consume you. Yes, we're living through significant times. Yes, understanding these dynamics matters. But obsessively checking prices, spending hours daily on market analysis, and letting it dominate your mental space is counterproductive. Do the work to understand your thesis, build your position, then live your life. Check in periodically, stay informed, but don't let it become an unhealthy fixation. So where does this leave us practically? We're in a moment where multiple forces are converging. Currency pressure, supply constraints, industrial demand acceleration, and the early stages of a potential shift in market structure from paper to physical dominance. Gold has already priced in some of this dynamic. Silver has not, at least not proportionally. The divergence between the two, by historical standards, is extreme. This doesn't guarantee anything about tomorrow's price. Markets can remain irrational longer than you can remain solvent, as the saying goes. The gold-silver ratio could widen further before it corrects. But when you're thinking in terms of probabilities rather than certainties, the current setup offers asymmetry. The downside risk, assuming you're not over-leveraged and you're holding physical or low-risk equivalents, is limited by industrial demand and historical support levels. The upside potential, if supply constraints intersect with monetary demand in a tightening physical market, is substantial. This is the kind of setup that disciplined investors pay attention to, not because it's guaranteed, but because the risk-reward, given current positioning and underlying fundamentals, is compelling. For those who already hold positions, the task now is patience and conviction maintenance. Continue to educate yourself. Understand that volatility is coming. Prepare emotionally to hold through tests. For those building positions, scale in methodically. Don't try to be perfect. Accumulate physical metal primarily, with perhaps smaller allocations to other vehicles depending on your situation and understanding. For everyone, stay grounded in reality. This isn't about getting rich quick. It's about positioning for a potential revaluation of monetary metals in an environment where currency confidence is structurally challenged. It's about owning assets with no counterparty risk in a world increasingly defined by counterparty failures and broken promises. Step back from silver specifically for a moment. What we're really discussing is how to preserve and potentially grow wealth during a period of system stress. The current financial architecture, debt-based fiat currency, central bank manipulation of interest rates, deficit spending as permanent policy, is unprecedented in scale and, many would argue, unsustainable in structure. Whether the adjustment comes through inflation, default, reset, or some combination is unknowable. What's more certain is that adjustment is coming in some form. In that context, owning hard assets with intrinsic value and no counterparty risk isn't speculation, it's prudence. Gold and silver have served as money and stores of value for thousands of years across every civilization because they possess unique properties: scarcity, durability, divisibility, and universal recognition. Modern monetary systems have tried to replace these properties with promises backed by government decree. For decades, this worked reasonably well. But when the promises become too large relative to the productive capacity to back them, the system strains. We're in that strain now. Silver, because of its affordability relative to gold and its industrial necessity, offers a unique position at the intersection of monetary demand and real-world utility. It's not the only asset worth holding. It's not a magic solution. But it's a piece of a resilient portfolio that makes sense given current conditions. None of this means the system is collapsing tomorrow. Institutions are powerful and have many tools to extend current arrangements. Central banks can continue intervention, governments can continue borrowing, paper markets can continue influencing price. These things can persist for longer than seems reasonable, and they will until they can't. Your role isn't to predict the exact timeline, it's to position appropriately for outcomes you can't control and to maintain discipline regardless of what unfolds. If silver runs in the next 6 months, great, you were positioned. If it takes 3 years, fine, you weren't over-leveraged and you can wait. If the entire thesis proves wrong and none of this plays out as expected, you've allocated appropriately so it doesn't destroy your financial security. This is how you think about risk when you can't know the future with certainty. The title of this discussion was Deliberate: Gold Shines in Public While Silver is Loaded in the Shadows. What happens in public gets attention, media coverage, mainstream acceptance. What happens in the shadows, the quiet accumulation, the physical tightness, the diverging fundamentals, that's where real opportunity often lies. By the time everyone recognizes the opportunity, it's largely priced in. The asymmetric returns go to those who understand before consensus forms. This doesn't require special genius. It requires paying attention to fundamentals rather than narratives. It requires doing the work to understand supply and demand, monetary dynamics, and market structure. Most importantly, it requires emotional discipline to act on understanding even when it's uncomfortable. Right now, silver is uncomfortable for many investors. It's been disappointing for years. It's mocked in mainstream finance. It attracts both genuine researchers and hype artists, making signal hard to separate from noise. But for those who take time to understand what's actually happening, the supply constraints, the industrial acceleration, the monetary pressure, the historical extremes in ratios, the picture becomes clearer. You're not being asked to take a blind leap. You're being asked to evaluate evidence, understand probabilities, and position accordingly with proper risk management. The crisis we referenced isn't some future event. It's the ongoing debasement of currency systems worldwide. It's the accumulation of unpayable debt. It's the erosion of trust in institutions that have failed repeatedly to tell the truth or act responsibly. These aren't problems that get solved quickly or easily. They're generational challenges that will define investment returns for years to come. In that environment, owning assets that exist outside the system, that have no counterparty risk, that can't be printed or debased, that hold value independent of political decisions, that's not doom and gloom. That's simply being realistic about the world as it is, rather than as we might wish it to be. If you take nothing else from this discussion, understand this. Your most valuable asset isn't silver or gold or any particular investment. It's your ability to think clearly, act deliberately, and remain disciplined when others are panicking or euphoric. Markets reward patience, punish emotion, and eventually reflect reality, regardless of how long illusion persists. Build your understanding. Size your positions appropriately. Then have the courage to hold through uncertainty. The opportunity in silver, if it materializes as fundamentals suggest, will reward those who positioned before consensus, who maintained conviction through volatility, and who understood that the best trades are usually the most uncomfortable. Everything else is noise. Stay informed, stay disciplined, stay grounded. The landscape is shifting. Those who recognize it early and position wisely will benefit, but only if they can hold through the tests that always come before validation. Thank you for your time and attention. Now do the work, build your conviction, and make decisions based on understanding rather than fear or greed. The crisis is here. The question is whether you're positioned for what comes next.